Alrighty then, we can get on started here. We're gonna do the usual song and dance, where I'll just kind of go over some of the what we observed last week, and what that means probably going into this week. Any headlines over the weekend, or what's coming up this week, and some of the expectations, because a lot of people all week last week looked for a bounce, looked for a bounce, looked for a bounce, looked for a bounce, looked for a bounce. Couldn't get it. Kind of got it on Friday, and I say kind of because it was not, it wasn't like we didn't roar with a vengeance up. This wasn't the most fantastical short squeeze you'd see by any stretch of the imagination. In fact, I think it was the day with the lowest amount of volume. Yeah, pretty much since before the Fed. So that kind of tells you something as well, that could this turn into a big old bull trap? Abso-freaking-lutely. But no one knows. Obviously, we'll just have to wait and see. First of all, where we actually open on Monday, because it's been a relatively quiet weekend. We haven't really gotten anything that I think the market's going to take any note of. Nothing really from China or Russia. The same old kind of stories there. Nothing really domestically that'll at least affect the markets. But we did get a move off of the lows. Let's see. From the lows, we're up about almost 5%. So that is a bit of a bounce here, but it could just be the equivalent of this. We did something semi-similar here. 2-day bounce, straight back down. 3-day bounce here, thanks to the Fed, straight back down. So we'll see. And here you had a 2-day bounce that kind of led to 2 gap ups that both just failed stupendously. So that's why I'm going to be just cautious. I'm not saying that there's no reason we can't have a squeeze, because we are very over levered to the downside. There's a lot of negativity out there. AAII net bulls got near record lows down there. We had our first monthly outflows from retail since COVID. So you had a lot of catalysts that could lead to a squeeze. But again, even if we do have a squeeze, if we're truly in a bear market, I don't think that this is necessarily the bottom. There's no reason to think that this would be the bottom. The narrative hasn't changed, first and foremost. And also, there's Bank of America kind of notes that were put out Thursday or Friday about some of the internal stats that you typically see at the bottom of a bear market in terms of redemptions versus net assets under management, and outflows versus inflows. And we hadn't reached those extreme levels quite yet. So that's one thing to keep in mind. But we are pretty extended from the moving averages, and so there is still potential for a squeeze. Now, we do have options expiration this week. So Friday you'll have some gamma rolling off of the SPY. I believe a lot of that is concentrated around 400 or 4,000 in the futures. So that's something to keep note of, that I think the majority is concentrated around there. I don't think there's much call gamma at all. We're also, let's not forget, we're also very, very illiquid. The E-minis in particular have some of the lowest liquidity we've had since COVID. Since the COVID drop. So that's good for either direction, really, in terms of how quickly we could move. The lack of liquidity and lack of book depth means that these over-levered people, if the squeeze does happen, it could happen like this. It could again. So got to keep that in mind. Now, one thing I also wanted to note is that if we pull up fib retracements from, we could do from the top here. We hit that 23.6. 38.2 would bring us right in line with this little double bottom here. If I pull up the Qs, and we do if you could do a fib retracement from this breakdown, in which case we hit 38.2. If you do a fib retracement from this level, we've hit, we're almost at 38.2. And then obviously what the real move, in my opinion, would be from the top here, in which case it's kind of like the SPY. We're hitting that 23.6. So we've still got a little ways. If we wanted to see a 50% retracement, that would bring us back up into kind of this node in here, this kind of volume node, back up maybe towards the 20-day SMA. And that would be, if we did start squeezing, if we did get that squeeze, it could be a spot where we could see a little bit of capitulation, a little bit of maybe a spot to short back down. Do I think that the rest of the year going into the summer is just going to look like this? Not necessarily. We could have a month or two of sideways choppy action. I mean, that's not to say that we wouldn't be in a bear market anymore. We could have a month where, February, we kind of did this for most of the month. We up and down and back up. So really, we could have one of these kind of nasty months. And I'm kind of expecting that to come at some point, where we do get kind of just this gross action. Whether that's happening soon or not, who knows. But we're kind of at a point right now where Russia, the only thing that market's waiting for at this point is either escalation into Finland or something along those lines, because we're still waiting for the official NATO application there, and or maybe some kind of actual progress and ceasefire and the ending of that. So that's something that we need to listen for as well. China is its own thing. Their lockdowns do affect the market. They affect demand for oil 100%, but they also will affect a lot going forward. So we have to listen for those as well. And then you got the Fed, which the Fed's funny. The Fed's just funny, because they take 75 basis point rate hikes off the table. Then you get these terrible inflation numbers, and they're like, well, maybe, who knows. Meanwhile, you've got the Fed governors all out there saying completely different things. So it's really it's a it's a shit show as always from the Fed. Whether we get speakers from them this week or not, I actually don't really care. They can talk as much as they want. The market, you may get a wiggle from the market, but they're not going to be able to drastically alter this market unless we get something like Lael Brainerd back when she came out, I think near the top here, and said, "Oh, we're going to do a balance sheet reduction next meeting," and didn't end up happening. But something like that, a significant statement from someone actually powerful in the Fed, is all I care about, frankly. And this week, I mean, we do have some numbers. We have some economic numbers. It's not going to be the most, blow your mind week of numbers. We already got our CPI, PPI, Empire State Manufacturing Survey on Monday. You get a bunch of China numbers Monday night, so we can get a little sense of how they're doing economically with the Shanghai lockdowns, if we can believe those numbers. Tuesday could be interesting. We have retail sales. I would be shocked if we have anything other than blowout numbers, frankly, with what we've seen from consumer credit numbers and the credit card data. I mean, we're swiping that somewhere, and you could put a house on a credit card maybe, but you can't put any big ticket items on your credit card necessarily. So I would expect blowout retail numbers, but that's definitely something to watch because we're still waiting for two things: one, a market, or sorry, the labor market to actually show signs of cracking, and two, the consumer to actually stop spending, because those are the two things that have been very resilient. Industrial production on Tuesday as well, business inventories, housing market index. And Powell does speak on Tuesday at 2 p.m., some kind of conference thing. It looks like it's almost like an interview style with someone, I believe from the Wall Street Journal, maybe. So that's something that you would want to listen to, or at least be cognizant of if you're trading. Wednesday, housing starts and permits. Who cares? Petroleum, 20-year bond auction, sure. And then Thursday is jobless claims, which is interesting because we're over the last couple weeks we've been reaching new monthly highs in the jobless claims market. Starting to see a little bit of something there. Nothing too serious yet. By any means. Philly Fed, existing home sales, e-commerce, retail sales, leading indicators, yada, 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 some other small numbers. And that's really it. That's really all that we have ahead of us. And we're also at the very, very tail end of earnings season. I mean, we're getting like the retail companies, some small things in there. So we do have companies like Walmart, Home Depot, Target, Lowe's, Deere, Foot Locker. It's the retail section of the group. So that's we're at the end of that. So this week could be a squeeze, just albeit if we get nothing else to do and nothing else to listen to or play, or it could just be a really choppy, nasty week. But we'll have to see. I'm looking at every pop we get with a skeptical eye, personally. If I pull up kind of the last couple days here, I noticed, and this actually wasn't that bad, but I was worried because every time we were popping up, it just felt like we were getting knocked back immediately back down. Even in the pre-market, we were popping up and trending higher, knocked back down, popping higher, knocked back down. So it was something that I was just I was very cognizant of, that I don't know if this market has been able to catch a bid, but we did finally make a new low, a higher low and a higher high. First time that we've done that since the Fed squeeze and subsequent rollover. So right now we're in this volume zone, this volume node here. I'd be watching kind of this tail end around this 398 as your support, kind of where we dip bought Friday, when we had this kind of midday drop, if you will, at 2 p.m. It's kind of about where we saw the buyer step in as well. So I wouldn't want to see this drop off, because then we're likely heading back to lows. There's no reason to be buying. If we do start to pop back up, I mean, I will definitely be looking at 405 as my next big inflection point here. It's kind of a little bit of a above below game here that we played. If you were to categorize this as a giant volume node here, that would be about 50% of the volume node. So that would be kind of what I'd be looking at. And then after that, if we do get through that, you probably got a little bit of room to get some action under our feet as people squeeze it. Now Qs, same kind of deal. I mean, the levels more or less match up. It's just that tech has been a lot weaker for the most part. They lead us. Tech's let us down, but they could also lead us up. So tech is really kind of the one to really also be watching as well. And if I go out to the further time frames, just to give a bigger perspective before we kind of move on into some of the other stuff that I wanted to talk about. So weekly bar close, the weekly bar close, and that's that is relevant. So we almost shot a nice little long tail fucking doji here on tech. Same kind of deal with the SPY. Not quite as beautiful, but it's still two indecisive weeks is what people would categorize that as. You've got very long wicks, and it's more or less dojis, which tells you that we are moving lower, but it's at a very kind of indecisive rate, which tells me, that what happens next is that much more important. It's not that a doji is some magical, creature in the market, but it's what it represents. And these aren't perfect dojis, but it represents indecision in a battle going on, and that makes what happens next that much more impactful for people who watch technical analysis. So if we do start moving our way higher, then you could definitely get a bit of a bear market rally, and we could see something out there because we just had a record amount of, I believe this is like in the last 11 years or so, uh, six straight, is it six or five? Six straight red weeks. So that is something to note as well. We're getting to the extreme side there, and then IWM is the IWM. What more can I say? We did touch down to the pre-COVID highs. We did touch those and then kind of pop back up. So maybe that's I don't even want to care to watch them. I know people want to buy them. I have no desire to buy the IWM. It's gross. But anyway, and also to put some things in perspective, SPY hasn't still reclaimed 2021's open. We haven't even retraced last year's move. To put that in perspective, I do think that there could be more pain ahead. Absolutely. We didn't quite reach 50% retracement either. That's not until about the pre-COVID highs, almost pre-COVID highs. Not quite, but I actually would love for us to get down to that 340s because then we can see what happens. But for us to get down there, I think we really have to start to see either a crack in the labor market or some issues from the consumer where their spending has subsided or is starting to soften, because then we have not priced in recession at all. This is not recession. This is pain, and this is Fed policy or frustration, but it's not anything like that. I mean, if you look at the bond market, you see something completely different, obviously, and this is definitely something that we can't ignore because they're not popping. And so that we did get that dislocation from the market and bonds in here in March when we squeezed up. Bonds or the market was squeezing up. Bonds really didn't do anything. I mean, they popped up briefly, but they did pop. So if the bonds are making new lows, I don't know if I trust the market to squeeze. I don't know if I trust any squeeze in the market necessarily. The bond market's been pricing in pain much more than the stock market itself, and they've been pricing, and they're already going down towards COVID lows here. So it is something that we need to to keep an eye on as well. And then rates. I mean, we've talked about rates. Rates have gotten up to levels since we haven't seen since 2018. With the Fed hardly doing anything, we've gotten two rate hikes here from the Fed. I mean, we haven't even touched the balance sheet yet. So it's like the Fed hasn't really done anything yet, and rates, have really already begun their party. We'll see what we do here. It's obviously, I guess, again, another thing we got to watch because tech will respond based on the velocity of rates rising. And then VIX. VIX is something that we noted that was also kind of diverging. We didn't really ever see the VIX participate when the market was making new lows. VIX just kind of stuck here. And that told me that people weren't buying those short-dated options. We weren't seeing some of that being put on. And maybe that's because people already put on everything they wanted to. Maybe there isn't that kind of fear index yet. Who knows? But it was something that we saw that was diverging, and so now we're getting that pullback in the VIX. We'll see at what point we kind of hold, but it was an interesting thing to see out there because I don't know. We're gonna have to watch. I don't know what to expect from the market this week because, like I said, it is options expiration, and sometimes we can get pinned to some levels if gamma gets really funky, and if gamma gets really high, and if dealers start trying to hedge themselves in every direction, and you start seeing a lot of movement. So we'll have to wait and see on that. But other than that, that's really it. We had our GDP contract. So did the UK, by the way, both surprising. So we are technically halfway to a recession, but that's it's technicality, a technical definition. So I wouldn't worry too much about that. But that is something that we're starting to see around other countries as well, starting to happen. And then in terms of some of the commodities, I mean, oil, it's oil. I see no reason to have a bearish thesis for oil. Uh, there's the one bearish kind of maybe force pull that could pull oil down is when China does reopen, demand comes back. This weakness, or this strength in oil is as much supply as it is voracious demand from countries, especially with what's going on with Russia. But if China does officially reopen, we could get a weakness in that. But right now, I mean, we've put in higher lows every pullback here, and we are starting to ascend again. So it does feel like oil's starting to ramp back up. But we've already done our SPR releases. We're doing our SPR releases, and in fall we're gonna have to start buying oil back. The U.S. is back in the old sell low buy high right now to replenish their stock in the fall. So that's gonna be fun to watch. Because that's gonna be impactful. I don't know where we'll be by fall, obviously, but oil, it's still strong. It still feels like it's been strong. It's been one of the better, because I've started trading futures like this week, last week or two. It's been where the better trades have been for me personally, catching it on moves and seeing stuff actually get moving. Oh, was that up? It was now. Go back to the hourly. Catching breakouts and catching pullbacks. It does have nice breakout potential, and it is sitting back up here at highs. So we'll have to see what we get from oil. But again, it's just something else to watch. Gold, meanwhile, getting the shit kicked out of it. It continues to get the shit kicked out of it. I mean, it's partially due to the strong dollar. Let's people overplay and underplay the relationship between gold and the dollar. I think it's neither one for one, nor is it just completely independent of each other. I think there is influence, but the dollar is also something we need to watch the market, because the dollar has been this is absurdly strong. This is a very, very strong dollar right now, and is the safe haven right now. The safe haven right now at the current moment is the dollar, and people are maybe even pulling money out of the markets for that. And so with the dollar going up like this, and with gold going down, where do you want to put your money? You want to buy gold? Great. This thing's back now where it's been for months. Now, I do think we are going to get a bounce in here at some point personally, but with all the different narratives out there. But we need to wait for this downtrend to finish, for maybe the dollar to slow down, and for people to start looking to rotate money elsewhere, because this is not attractive. And then obviously, we joke about crypto, but we do need to watch crypto, because over 50% of crypto investors are underwater. And we've talked about like when Netflix got obliterated with earnings, margin calls, people getting forced out of positions, and they don't sell the losing positions when they have margin calls and when they need extra cash. They sell the winners, like Apple. We finally started to see Apple get hit. Tesla really finally started to look weak in here. And Bitcoin could be the same thing. If there are investors who are going to get margin calls in crypto, if they have other investments, they're gonna, if crypto stands are weird, and they'll sell all their other positions to try to keep that crypto alive if they can. So we could see more margin calls in the market if crypto continues to implode. We've talked about, there was a couple, big companies with big margin calls, I think around 21,000 in Bitcoin. I think that's the level. So that is something that we need to watch. Now, we got to a pretty nice bounce level, so I do think we could get a bounce in here, maybe even just to fill the gap at 35,000. That would be my guess. But definitely we need to watch crypto, because there's a lot of money in it. There's a lot of money in it, and if it does start getting hit, margin calls are a thing, and especially with how over leveraged the market is, you could see some of the leaders get hit even further. And like Mike said, they do eventually come for the winners. Apple just starting to finally, they're just starting to come for it. And if someone's like, "Oh, Apple's cheap now, I'm going to buy," I mean, zoom out a little bit, get a little perspective here, because I mean, Apple's quote unquote cheap. We're still 200% higher than we were COVID lows, and over 100%, almost 100% higher from COVID highs. So they have been hitting Apple, but nowhere near to the degree, Q's took out their 2021 gains. Apple's nowhere close. And Apple is an institutional safe haven for a reason, but there are still leaders out here that could get hit. And while it's all nice and fine, we talk about the bubble that's popped in stocks like Zoom and Peloton and like Overstock and Fastly and all those guys. We've talked about those guys. These guys aren't moving the market. Apple and the FANG, the big boys. That's what moves the market. You think the market can go lower? You need these guys to do it. Because that's what's going to do it for us. So Amazon, obviously, we're back down almost to COVID high, pre-COVID highs on Amazon. Netflix, I mean, Netflix is blown through COVID lows. Google's just starting finally to get hit a little bit after their earnings. Microsoft, same kind of deal. But if these guys get hit more and we do see rotation out of the big boys, then the market could really start to pick back up on the downside. But otherwise, it's just going to continue to be this grind fest that we're seeing because the market is very weighted to those guys. It's like 30, just a couple of those companies hold the majority of the market cap. So it's something we got to keep in mind. Other than that, stocks I'll be watching and some of the stuff I'll be watching going into this week, it's going to be the same kind of stuff. The problem is that if we're going to get a very big rally or if we're going to get a very big drop, a lot of stuff is going to go with the market. So you kind of have to get a feel for that. Nothing's going to be, not much is going to be impervious to the market if we get a very drastic move in one direction or another. So what I have is I have stocks that I'm going to like to reinitiate shorts on that I think, oh, I'd love to reshort this company. A company like Starbucks, like they're having more companies, or more branches rather, continue to unionize. I don't know. I just I think they have issues. I think their last earnings were actually okay, but if I'd want to buy stocks, Oxy obviously, all the energy companies continue to blow out earnings. They have more money than God right now in free cash flow. Warren Buffett loves this company as well. Stocks like that. And then if I'm looking for other stocks to get hit, like dollar and a quarter tree, this one's just finally starting to feel the pain. So I'm looking for catch-up trades on the downside as well. Something like that, or like AbbVie, something that's kind of lost its steam but hasn't quite started catching up. So that's exactly what I was looking for. Something like Costco. Costco was a stud for like 2 years, and then suddenly, last month, it wasn't, and we're down, what, almost, no, not quite 30%, but we're down. We're getting hit pretty hard, like almost 20% or so. So that's what I'm looking for in some of the catch-up trades there. And we'll see when I get it, if I get it. I'll also look at the crap companies like a Firm that I'll look to maybe short back down, or Coin, But the problem is Coin will probably bounce around with crypto. And with some of these shit stocks like Roblox, like, again, I want to point out, look at the volume we've done on these guys over the end of last week. This was serious volume, which does tell me we could potentially see a bit of a bounce in them. We talk about blow off tops and bottoms, and volume is one of the key indicators of those guys. So I'm going to be looking at these guys and watching them. I'm going to be very hesitant to. I'm not super excited to want to short Roblox quite yet. We've hardly had a bounce. I mean, yeah, it's 50%, but 20 to 30. That's there are a lot of bag holders, but again, this type of blow off volume tells me that a lot of people participated. Maybe it was a lot of people trying to dip by. Maybe it was a lot of short covering, who knows? But Roblox, Coin, and look at ARK. I mean, ARK just, exploded in volume. I'd have to zoom out. I don't know if this is the most amount of volume it's ever done. It looks like it is. I think we just did the most amount of volume in a day ARK Fund has ever done, and that was last week. So that's interesting. It's very interesting. I have no idea what that volume is. No one does. But it could be, it's just some people scooping in. It could be a temporary blow off bottom. And a blow off bottom and a blow off top, they're not permanent tops and bottoms. They can be, but they're not usually. They're just momentary. You get that like a slinky being stretched too far, or a rubber band. It's going to snap back and then it can start going back because it reached a point of extreme. So maybe we get the bounce, but that's something that I'm noting and I'm very cognizant of with some of these shit stocks. Roblox, Coin, Bumble maybe. Bumble not to the same extent. Unity, Upstart. A lot of these guys did a ton of volume. Some were due to earnings, others were just due to just the serious amount of selling that we saw. So I'm going to keep an eye on those guys just out of curiosity. I will watch the casino plays because they've been getting the absolute hell rocked out of them. They never really bounced off COVID lows, and they did just have that report from the gaming industry that U.S. casinos just had their best month ever, historically ever. that doesn't sound to me. My first thing is, well, the house always wins, so I wonder if consumers are out there trying to bet, the little bit of money they got left and they just lost it all. I don't know, but maybe not. But anyway, the casinos just had, their best month ever. So maybe I'll look for a little bit of a bounce in some of these plays. Who knows? The reopening sector did get smoked over the last week and a half, so they could use a little bit of bounce. Look at Expedia, look at Airbnb. Some of these guys, actually had good earnings. But we'll see if we get that there. I might be a little ambitious looking for a bounce in some of these. I'll also just look for ones that I like, in terms of setup. I mean, I still like Pfizer. I like that we're back above the 200-day. I like that we're trending higher a little bit here. It is technically one of the more cheap ones value-wise. I don't know, stuff like that. It's going to be a lot of the same stocks that we've been trading every day, and then you just see what's in play for the day. It's the same kind of stuff. It's the same stuff almost every week. But in terms of stocks that have earnings this week that I'll be interested in, Monday morning we have Monday reporting. This is like an Asana competitor. So, maybe you get a little action in both those stocks if we get something. Wix, which is again another quarantine passed stock, which, probably won't do too much. Same with Warby Parker. I'm not too excited there. Monday after the close, you get Take Two. This is a stock that's been smoked pretty recently. We'll see what we get there. Tuesday, you get Home Depot. You get C Limited, which Kathy Wood, I believe, just sold some of, which I joked about because she's usually buying in front of companies' earnings, and then the company gets smoked on earnings. So she just sold some of this. So I'm expecting them to bounce on earnings, frankly. But we'll see. Walmart reports, and Walmart's been. I mean, just look at those daily bars lately. It's just gross. Thankfully, I haven't watched it lately. Tuesday after the close, you have like Docs and Keys rather. I don't know, TCS, so Container Store. Wednesday you do get Colgate, Lowe's, Target, TJ Maxx. So like I said, more retailers. Wednesday after close you get Cisco, tech stock. This comm sector's been getting crushed. We have BJ's Thursday, Kohl's. We do have the cybersecurity sector reporting some. So PanW reports Thursday, and this is another sector that again, it's interesting to see this kind of selling like this because this was a sector that a lot of people are like, oh, war with Russia, a lot of hacking, proxy war, cyber should do well, and it may have been somewhere that some institutions were hiding out at, and that's what that volume was them bailing on it. I don't know, but that's some nasty selling there. Nice little bounce back after Cyber's earnings, so maybe we get the same kind of thing in PanW on Thursday. Who knows? And then you have like Deere and Foot Locker. But that's really it for me. I mean, we get Fed minutes, not this week, but the following week. It's options expiration, light on earnings, light on headlines. I'm probably going to be cautious this week. I don't know. I don't have a good idea of is this the extent of the bounce we're going to get. So Monday's probably going to be exceptionally light for me unless we're gapping and doing something that I really like or I see something clean. We kind of closed in a volume node there, a 2-day consolidation volume node, but still. I'm going to be very hesitant to see if we get smacked back down because we've had 2-day, 3-day rallies just get obliterated the following day. So I'm going to be very careful with that. And even when we put in like a bottom, say like here, we still chopped around. We put in a blow off bottom here. We still kind of chopped around before we got that squeeze. We rarely kind of just shot this V for victory on the daily in the SPY. So there's usually a bit of a battle before we squeeze. So I'm going to be a little careful here this week. I'm going to be watching if the price action tells me and looks strong and looks like we're going to squeeze, then great. I'll look for some of the stocks that I think could be a little overcooked on the downside or that I think are still strong and look relatively good. If it looks like we're going to fail and get smacked back down, I'll look for the stocks that I think look particularly weak or I think people could come for, even like stocks like Apple, which really hasn't had a lot of give back yet. So it's going to be interesting. And obviously, we'll have the day traders like GME. That one kind of woke back up a little bit. I think that's probably going to die again, but I think we'll get some action like that as well. But that's it for me. It's going to be an interesting week, and this is one of the weeks where I'm just not going in with a lot of confidence. And so I'm going to listen to my intuition. I'm going to be very careful. I'm going to manage my risk exceptionally. And I might scalp more, frankly. But we'll see.